Hi, welcome to Search for Yields, the fortnightly newsletter from INR Bonds. I'm Arjun Patsati. And in this edition of Search for Yields, we're going to talk about the 5 reasons why gsecs should be part of your fixed income portfolios. The main reasons are, one is that the Government of India bonds are issued and by the Government of India, and it carries zero capital risk. But the caveat here is that if the bond should be held to maturity, if and to get the full benefit of the zero risk availability in terms of gsecs. The second is that there is a potential for capital gains because gsecs are traded in the market and prices can rise in a favorable environment. And when prices rise, you can make capital gains by selling the bond at higher prices. And it carries only 10% capital gains tax if sold after 1 year. So it has a tax efficiency on the capital gains front, as well as can potentially give good capital gains for investors if invested at the right price. The third is that it has a wide variety of maturities. That is, investors looking for short-term investments, 1 to 5 years or 6 years or 7 years, can invest in 1 to 7 years maturity gsecs. Investors looking for longer period of time, 10 years, 15 years, 20 years, can also invest. And very long-term investors can also look at 30 years, 40 years, and even 50-year kind of bonds for gsecs. So they have a wide maturity profile and can give a good solution for investors looking to vary their investments in terms of maturities. And it's very easy to buy and sell gsecs. Gsecs are available on bond platforms like INR bonds, and also through the RBI retail direct platform for gsecs. So there are 2 ways investors can invest. To buy through platforms like INR bonds, all investors need is a Demat account. Now, coming down to why capital gains, how can you make capital gains on gsecs? Very simply put, if you buy gsec at say 100 rupees and the price goes to 105 rupees, then 5 rupees capital gains you can make. And that 5 rupees capital gains, if you're selling after 1 year, it's only taxed at 10%. But again, like I said, the caveat here is that you have to make sure that you're buying at a price which is right and has a potential to increase from here. And GSEC yields, now prices normally increase when interest rates fall in the economy. Now, so you have to look at why interest rates can fall in the economy and why GSEC prices can rise. One is that inflation, RBI is on a inflation fighting spree, and they have been at it for more than a year now. And that's keeping inflation expectations down in the economy. That means inflation, which is running very high, can stabilize and fall as well, which is very positive for interest rates to come down. And then RBI may stop fighting inflation, and then interest rates can come down. The second is that the government finances are very positive. If you're investors looking at GST collections, everybody pays GSTs and tax nowadays. So if you look at the numbers, are very high and rising very fast. So that government finances are very good. So that means when government finances are very good, that they can limit the supply of gsecs in the economy because they don't have to borrow higher, as they can match their whatever budget deficit they have given in the budget. The third is that globally too, there is inflation looks to have stabilized in most economies. It's come down from higher levels. And those of you following equity markets, one of the biggest talk is that of US Federal Reserve keeping rates high and what is the effect of risk and other things. And now Fed is saying that they can keep interest rates stable for a while till inflation comes down. And if that does happen, then there is potential for stability in GSEC yields. Now, one of the biggest news in this year for both equity bonds and currency markets is that India is being included in foreign bond indices, global bond indices. That means GSEX will be included in global bond indices, and that will enable more foreign investors to buy GSEX. And this will also limit the supply of bonds, which is available for investors in India. And if the government finances are good, that means the demand and supply, there could be a mismatch where there is more demand and less supply. And when there is more demand and less supply, prices do tend to rise. So that is one, arguments in favor of GSEX. However, you have to understand the risk factors. That is, if GSEC prices fall, supposing from 100 rupees, they fall to 90 rupees, there's a 10 rupee capital loss. And if somebody wants to sell the bond, that means they incur that capital loss. But however, if they hold the bond for maturity, then they don't incur that 10 rupees, because at the time of maturity, they will get back rupees 100 from the government of India. So the capital loss is zero if held to maturity, but if sold before that at lower prices, there is definitely chances of capital loss and lower returns. So how to buy and sell GSEX in INR bonds platforms? INR bonds is a SEBI registered online bond platform provider and can offer GSEX to retail individual investors. And the lot sizes are low, from as low as rupees 10,000 and can go up to any size, because it's a very big market. GSEC market is it is the biggest market in India in terms of volumes traded. The second is that investors only require a Demat account. So any investor investing in equities would have a Demat account, and all it requires is you to have a Demat account. And all the settlement is done through the NSE process, which is very simple process. So there is investors do not have to pay. All they have to do is transfer money to the stock exchange, and they will deliver the bonds to your Demat account. It's as simple as that. So the GSEX have a good argument to form a part of investors' portfolio. One is they are carrying the highest safety instrument with potential of capital gains, which can give them much better returns than other fixed income options available to them in the market, like fixed deposits or other expensive products like insurance and other things. Bonds can give better returns, but corporate bonds can have credit risk, whereas government bonds do not have credit risk. Thank you for listening in to Search for Yields. Do follow us on our YouTube channel if you've not done so already.
Attention financial advisors. Want to attract new business and customers? Offering a new asset class is the key. With debt mutual funds and MLDs losing their tax advantages, your clients need to diversify fast. Look no further than corporate bonds, the perfect solution for safety and good returns. Partner with INR Bonds for expert guidance and valuable resources to get started. Access a wide range of bonds on our portal and manage your client investments with ease. Visit partners.inrbonds.com today and unlock new business potential.